Hear me out. The RBA is going to jack up rates at least 2 more times this year. Affordability is at an all-time low. House prices have been rising at the fastest pace in history over the last 5 years. Too many people have taken on risky mortgages, and if history is anything to go by, whenever something like this happens, the property market eventually cracks, but maybe not in the way that you expect, which I'm going to unpack in this very, very important video. Now, am I wrong about this? I'm pretty sure most of you watching this video would agree with me, because it does sound completely logical that the market would crack. In fact, when you look around, there are more than enough factors that should be pulling demand down. You've got oil prices rising because of what is happening in the Middle East. You've got volatility in global markets. A lot of people have seen their super take a massive, massive hit. And on top of that, you've got borrowing capacity, which is being squeezed back again. So logically, when you look at all of that, in an environment like this, it becomes more about when, not if. When will prices correct in the housing market? In fact, a lot of people have a lot of clickbait out there. The market's going to completely collapse. But let's actually unpack the truth and figure out what all this is. Guys, it's Scott here. Now, to actually answer that question, we need to go straight into the data, not opinions, not clickbait, not headlines, not fear, real data. Because I've gone through Cotality's latest report, one of the most trusted property data houses in the country, and what it shows about how the market is reacting to rising rates, the oil shock, and affordability pressure is not what most people expect. And more importantly, it directly answers the exact question that a lot of you are asking right now. Now, if you're a renter, you're probably wondering when you can realistically get your shot at buying your first home, and if you've got the money, is now the right time. If you're a first-time buyer, you're also trying to figure out whether to enter now or wait. And if you already own a property, you're probably asking what happens to the equity in your home from here, because the equity in your home is the main source of your net wealth and your net wealth position. If you're a property investor, you're also asking the same question. Should I invest in property right now, or should I wait? No matter what camp you are in, this video is going to give you a lot of powerful information so that you can make the right choice for you and for the people that you care about. Now, I'm going to show you how much heat is still left in this market, when it is expected to slow down, what forces are pushing prices lower versus what forces are still pushing them higher, and what to prepare for in 2026, and most importantly, what you should do next. So do me a favor, lock in, switch off the distractions, because this is going to be all about real data, real insights, and how you actually navigate this market. Now, before we get into it, I do cover property, policy, and the economy every single day. So hit subscribe and the bell icon so you can stay ahead of what's happening with your money, so that you can take care of the people that you care about. Okay, let's get into it. All right, guys, I'm going to go through the report and discuss the biggest bombshell findings from Cotality, because everybody in property swears by these reports, and Cotality usually has the market pulse right. Not always, but normally in a directional way, they are very, very accurate, and they have the biggest pool of data. So it's a very important source for us to look at. Now, the first big finding is this: national prices are still rising, defying all the odds and all the negative headlines. That is where most people are caught off guard, because when you listen to the news, all you hear is rates, oil, war, inflation, uncertainty, collapsing sentiment, and recession fears. So you would think property must be rolling over hard. You must think the numbers must be falling back. But nationally, that is not what the numbers say. Cotality shows national dwelling values rose 0.7% in March, not a few months ago, I'm saying March. And they rose 2.1% over the quarter and are up 9.9% over the year. PropTrack tells a similar story, with the national median home value rising to about $908,000, up 9.4% over the year, which is roughly $94,800 higher than 12 months ago. So yes, Sentiment has taken a hit, but prices have not fallen off a cliff. That is the first thing that you need to understand from this data. But the question is, for how long will the market continue to skyrocket? Something has to give, right? Now, data shows that there is this one segment that is indeed slowing down, one part of the market that will slow down, that will bring down the overall averages. Now, let me show you what that one segment is. Australia's housing market has officially become a 2-speed market, maybe even a 5-speed market, depending on which report you read. But to simplify it, let's say 2-speed. On one side, you have the expensive end of the market, the luxury end of the market, especially in Sydney, where prices are either flat or drifting lower. I'm talking about the upper end of the market, which is beyond most Aussies' reach, averaging around $2 million for a house and above. Now, on the other side, you have the more affordable end of the market in smaller capital cities and also certain suburbs in Sydney and Melbourne and other places where prices are still growing. This segment is where all groups of buyers are rushing with their money. So demand just doesn't disappear, demand shifts. That's a key lesson. Let's take Perth, for example. It rose 2.5% in 1 month alone. That is massive, and 24.3% over the year. This takes the median value in Perth to over $1 million. Let that sink in. Now, Brisbane rose 1.8% in March alone, 19% over the year, with median values around 1.1 million. These are affordable cities. I mean, they're affordable overall, but just think about that for a moment. Perth and Brisbane are now at $1 million. Meanwhile, Sydney was down about 0.1%, basically nothing in March, and down 0.2% over the quarter in one data set. Basically, this is like nothing. This is no movement, ultimately. Do you see a pattern here? Demand has not disappeared. Demand has moved from the unaffordable end of the market to the more affordable one. The demand remains. Now let's talk about the wrestling match going on underneath the surface, because there are definitely forces pushing prices lower. There's absolutely no debate about that. Interest rates are one of them. Borrowing capacity is getting squeezed again. Most new borrowers now need to prove they can service a loan at 9% once the serviceability buffer is added in. Remember, in Australia, to protect our housing market, the government says you've got to afford an interest rate 3% more than what the banks actually charge you. This is why our market has never been smashed, and this is why our market will easily absorb 2, 3, 4 interest rate rises. The RBA knows this. The RBA never wants the property market to crash, neither does the government. They know there's a 3% buffer in our market. Now, this of course obviously shrinks the pool of buyers, especially at the expensive end, that pool of buyers then moves to the more affordable end. Then you have falling consumer confidence. Consumer confidence has hit its lowest level in 53 years, which is wild. At the same time, house price expectations have hit their highest level in 15 years. So people feel terrible about the economy, but they still think house prices are going higher. That tells you a lot about how broken affordability has become in Australia. Then you have oil prices, inflation fears, and talk about recession. People are understandably nervous. When households feel under pressure, they hold onto cash and delay big decisions. Yes, these things are dampening activity. Auction clearance rates, for example, in Sydney have softened. Sydney clearance rates have slipped below 50% in some recent reads, and in the final full week of March, more than 4,000 auctions were scheduled nationally, but only about 61% sold at auction, which was the weakest early read since late 2022. That tells you buyers have more choice and less urgency in some pockets. All of that is real. But now look at the other side. First, supply is still too tight. Perth listings are still around 40% below average. Brisbane and Adelaide listings are roughly 20% below average, so when demand softens, low stock stops prices from correcting properly. Second, we are still not building enough homes. Over the first 15 months of the Housing Accord, about 81,000 homes were completed, which is roughly 27% fewer than required to stay on track for the 1.2 million homes by 2029 target, what I now call a PR target by the government. That is a massive undersupply. Third, investor demand is roaring back. Investors are hungry. They see the long term. New loans to investors are up about 64% since early 2023, and around 75% of investor inquiries are for properties under $1 million, with about 55% targeting properties under $750,000. So investors are now fighting first home buyers at the affordable end of the market. That is one more reason those lower price brackets are staying extremely hot and are growing. Remember, there's 15,000 suburbs, and I actually do have the data and I do know the locations where there is the most demand and the least amount of supply, and prices in those locations are growing like crazy. And investors are still very, very keen in these areas because the rental market is still brutally tight. Properties are leasing in around 20 days nationally, and in Brisbane, Adelaide, and Perth, it is as low as 18 days to get a property rented. Rents are up roughly 55% since the start of the pandemic, and in the latest quarterly update, rents rose another 2.1%, over one quarter in 90 days, which was the fastest 3-month increase since May 2024. So if you are an investor, the logic is very simple. Tight vacancy, high rents, strong cash flow, ongoing supply shortage, and also the belief that even if prices slow down or even dip temporarily, they are not collapsing, and long term, they are growing. Then you add in FOMO, fear of missing out. You add the 5% deposit scheme, which pulled future demand into the present. Then you add in the bank of mum and dad. Now remember, mum and dads with 1 or 2 properties are seriously wealthy right now. You add migration, you add intergenerational wealth transfers, you add buyers widening their search instead of quitting the market. It goes on, and that is why prices are still holding overall, but remember, at the lower end, they're growing. And the current Middle East crisis is only going to make things worse. Construction costs are rising again because of the current oil shock. Fuel feeds into freight materials, transport, machinery, and development margins. If it costs more to build, replacement values go up, and when replacement values go up, established property gets a boost as well, and we build less, which makes the supply crisis worse. So yes, higher rates are a headwind, but under supply, investor demand, policy distortion, rent pressure, and rising build costs are still a bigger force in most affordable markets. Let that sink in. Now, a lot of people are going to say, all right, Scott, fine, but what about risky debt? What about all the people who borrowed too much? What about the so-called mortgage cliff? And we saw these headlines a few years ago. Completely fair question and a great question to ask. But the data does not show mass forced selling. It didn't happen 2-3 years ago, and it won't happen now. Mortgage arrears are only around 1 to 1.5%, and less than 1% of households are in negative equity. That matters a lot, because the property market only really crashes when people are forced to sell into a weak market. If owners can hold, the market will bend a little, but it does not necessarily break. Now, I know some of you are thinking, Scott, you opened this video sounding like the market should be crashing, and now you're telling me it is still rising. Now, I'm not going 180 on you guys. In normal circumstances, what is happening with rates, oil confidence, and recession fears, this actually should cool the market. That part is true, and the market is cooling in certain areas. You are not wrong for thinking that. But when you look at the data and the actual forces underneath the market, especially the supply shortage and the policy settings that keep dragging more buyers into the system, you realize this market is not normal. So what does this mean for you? If you are a first-time buyer, I would be very careful waiting for some giant crash, especially at the affordable end. That end of the market is where the deepest demand is, and is also where supply is thinnest. You can wait for rates to come down, but by the time that happens, you may be buying the same property at a much higher price. Sometimes buying now at a higher rate and refinancing later is actually the smart financial move. Now, if you are an investor, the rental fundamentals are still too strong to ignore this market. If you can add new supply to the market, especially by buying new stock or funding new dwellings, you'd actually be helping Aussies and actually helping the government. And from a pure investment lens, tight rents, low supply, and resilient price growth still make a strong case. And myself, I represent over 10,000 investors, and I negotiate with owners of brand new property, builders, developers, and landowners, and they are more negotiable than ever. Now is actually a really good time. If you are a renter, I know this is the hardest position, I really do. And sometimes the answer is not buying where you live straight away. Sometimes the answer is rentvesting, buying where you can afford, letting that asset grow, building equity in that property over there, and using that later to bridge the gap into your own home at some future point. The point is, do not sit there waiting for the market to rescue you if the data says the rescue is probably not coming. By the way, I'll put a link in the description about rentvesting because this is a strategy many renters should look at right away. Now, you tell me, do you agree with this report or not? Do you think the market is setting up for a correction, or do you think the affordable end is still going to keep pushing higher? Because when I look at the data, I do not see a market that is crashing. I see a market that is splitting, where the expensive end is slowing, but the affordable end still has way too much pressure on it. If you found this information useful, hit subscribe, hit the bell icon, and share this with someone who's trying to figure out what the hell they should do right now. I do these videos every single day so that you can make the right financial moves for you and the people you care about. By the way, I generally read every single comment. Your thoughts, your opinions matter, and your voice adds power to this conversation. And when many Aussies get together and build a community with strong voices, governments must take note. So I really appreciate all your comments and all the people that support this channel. I'll see you guys at the next video.